I made my first million in my 40s, my first billion in my 70s. I've outlived, outread, and outearned nearly everyone I started with. You want to know the difference? The real, unvarnished truth that separates the permanently wealthy from the temporarily lucky? I stopped doing stupid things. That's it. That's the grand secret. While everyone else is out there searching for the key to unlock the treasure chest, I was busy making a list of all the ways you could accidentally blow yourself up with dynamite, and then I just didn't do any of them. Everyone is looking for the secret stock, the perfect algorithm, the one weird trick. They think wealth is an act of addition. It's not. There is no secret. There is only a list. A short list of catastrophic, boneheaded, wealth-destroying mistakes. If you manage to avoid them, you win. It's that simple. It's a game of subtraction. I have watched men with genius-level IQs, men who could calculate the trajectory of a rocket in their heads, utterly destroy themselves financially. They weren't dumb. They were just fools. They made simple, emotional errors. Today, I'm going to give you the list of brutal truths I've kept to myself for decades. The 7 mistakes that will cost you not just money, but time. Decades of your one and only life. Pay attention. Because if you're making just 3 of these right now, you're already 10 years behind schedule. Truth number 1. You are addicted to complexity. That's a mistake, a fatal one. You think that a complex problem requires a complex solution. You build elaborate spreadsheets with 100 variables. You subscribe to services with blinking charts and arcane indicators. You think you can outsmart the market because your model is more sophisticated. This is utter nonsense. It drives me insane. I, on the other hand, look for 1-foot hurdles I can step over. Not 7-foot bars I have to vault. I don't need to be a genius to understand that people will still be drinking Coca-Cola in 50 years. I don't need a PhD in finance to see that a railroad has a durable competitive advantage. The best ideas are almost always the simple ones. Let me tell you about long-term capital management, LTCM. In the 90 seconds, this was the smartest hedge fund on the planet, run by 2 Nobel Prize-winning economists, filled with the brightest minds from the best universities. They built the most complex, computer-driven trading models the world had ever seen. They were leveraged 100 to 1, betting on tiny, predictable movements in bond markets. And for a while, they were gods. They were minting money then, in 1998. Russia defaulted on its debt, an event their models said was statistically impossible. And the entire, beautiful, complex machine didn't just break. It vaporized. It nearly took the entire global financial system down with it. The smartest guys in the room, wiped out by one simple thing they couldn't model: human panic. And here you are. You spend 10 hours researching a $50 toaster oven, reading every review, comparing every feature. But you'll throw $10,000 at some biotech stock you can't even pronounce because you saw a rocket emoji next to its name on a forum. It's idiotic. Here's a simple rule: the kindergarten test. Can you explain why you own an investment to an intelligent 5-year-old in 1 minute so that they understand it? If you can't, you don't own the investment. It owns you. Here's your homework. Tonight, go through your entire portfolio, every single holding. If you can't pass the kindergarten test, sell it. I don't care if you're at a loss. Sell it. The price of your ignorance is far higher than any small loss you might take today. Truth number 2. You are ignoring the most powerful and predictable force in the universe, human stupidity, starting with your own. This is not just a mistake, it's financial suicide. You think investing is about numbers and charts and earnings reports. You think you're a rational being making rational decisions. Wrong. Completely and utterly wrong. I don't try to be brilliant. I just try, very hard, not to be an idiot. And I assume everyone else around me is susceptible to waves of idiocy. I spend more time reading history and psychology than I do reading annual reports, because the numbers change. But human nature doesn't. Look at the South Sea bubble in the 1,720 seconds. People were trading shares in a company with a monopoly on trade with South America, a continent with which England was at war. There was no trade. There were no profits. It was pure fantasy. Yet everyone from the common man to the most brilliant scientist of the age, Sir Isaac Newton, got swept up in the mania. Newton himself lost a fortune, the equivalent of millions today. He later said, "I can calculate the motion of heavenly bodies, but not the madness of people." Or look at the dot-com bubble. Pets.com, a company that was losing money on every single bag of dog food it shipped, went public and was valued at hundreds of millions of dollars. Why? Because of a sock puppet and the word .com. It was pure, unadulterated madness, and it ended in tears, just like every bubble before it. You do the same thing on a smaller scale. You see a stock going up, and you call it genius. FOMO, fear of missing out, kicks in. You buy at the top. You see it going down, and you call it a disaster. Panic kicks in. You sell at the bottom. You are not analyzing a business. You are reacting to a squiggly line on a screen, like a Pavlovian dog salivating at the sound of a bell. So here is your rule. The inversion test. Before you ask yourself, how can I make this investment a success? First ask yourself, what are all the ways I could fail spectacularly with this investment? Greed, fear, stupidity, over-leverage, ignorance, fraud. Make a list of all the torpedoes that can sink your ship, and then just steer clear of them. Your homework. Read the book Influenced by Robert Cialdini. It's not a business book. It's a survival manual against the flawed wiring of your own brain. Do it. Truth number 3. You are listening to economists and market forecasters. My God, why? This is perhaps the most baffling mistake of all. It's just noise, a complete and total waste of mental energy. I have a simple view. If they knew what was going to happen, they'd be running hedge funds, not selling newsletters or appearing on television. Warren and I have been at this for over 50 years. We have never, not once, made an investment decision based on a macroeconomic forecast. Think about the financial crisis of 2008. The entire global economy was on the brink of collapse. Where were the forecasters then? I'll tell you where. In 2007, they were predicting another year of solid growth. They were completely and utterly blind. They built their models on the assumption that housing prices never go down on a national level. It was a failure of imagination, a failure to look at history. They were driving by, looking in the rearview mirror. And you hang on their every word. You hear a forecast for a recession, and you sell everything. You hear a prediction of a bull market, and you pile in. You're a leaf in the wind, blown about by the hot air of people who are paid to sound confident, not to be right. It's a pathetic way to manage your affairs. Here's the rule. The weather forecaster test. Would you bet your life savings on a weather forecast for this day? 1 year from now? Of course not. It's absurd. So why would you bet your financial future on an economic forecast, which is infinitely more complex and unpredictable? Your homework is simple. For the next 30 days, turn it off. All of it. The financial news channels, the market prediction websites, the expert talking heads. Unplug from the noise machine. Focus only on the businesses you own or want to own. I promise you, you will make better decisions. You will feel calmer, and you will not miss a single thing of value. Truth number 4. You are confusing diversification with diversification. The financial advisors taught you this one. They told you not to put all your eggs in one basket, so you went out and bought 50 different stocks, a handful of mutual funds, an ETF for every corner of the globe. You feel safe. You feel smart. You're a fool. What you have is a museum of mediocrity. My approach is the opposite. I believe in extreme concentration, in our best ideas. When we find a truly wonderful business at a fair price, we don't just dip a toe in. We back up the truck. Why would you put your 20th best idea on the same footing as your absolute best one? It makes no sense. Look at the great industrial conglomerates of the 1,960 seconds and 70 seconds. Their strategy was diversification. They bought everything. A rental car company, a hotel chain, a frozen food business, a tobacco company. They became a messy, unfocused, bureaucratic nightmare. They couldn't run any of their businesses well because they were too busy running all of them. And what happened? They were eventually dismantled, broken up, and their individual pieces became far more valuable on their own. They diversified themselves into oblivion. You're doing the same thing with your portfolio. You spend weeks finding one great company. Then you diversify that brilliance away by buying 19 other mediocre ones, just to feel safe. You are guaranteeing average results, at best. Here's the rule. The punch card rule. Imagine you have a punch card with only 20 punches on it for your entire lifetime. Each time you make an investment, you use up one punch. That's it. Only 20 chances. You would become incredibly careful, incredibly selective. You'd wait for the absolute perfect pitch, the no-brainer, before you swung the bat. That is how you should be thinking. Your homework. Look at your portfolio. Identify your 3 absolute best ideas, the ones you would bet the farm on if you had to. Now, write down a 1-page justification for why you own anything else. If you can't, you know what to do. Truth number 5. You are trying to solve every puzzle. You think you have to have an opinion on everything. The future of oil prices, the direction of interest rates, the winner of the electric vehicle race, the next big software trend. This is hubris. It's an admission that you don't know the boundaries of your own competence. I, on the other hand, have a very large and very important pile on my desk. It's labeled the too hard pile. The vast majority of investment opportunities that come across my desk go right into that pile. And they say there, I don't feel a need to understand quantum computing or gene editing. I don't have an edge there, so I pass. Think of Warren Buffett during the dot-com boom. He was ridiculed, called a dinosaur, a has-been. He was told he didn't get it, and he was the first to admit it. He said, I don't know how to value these companies. I don't know what they'll look like in 10 years. So he did nothing. He sat on his hands and watched the mania unfold. And when it all came crashing down, he was there with his pile of cash, ready to buy wonderful businesses at bargain prices. His greatest strength was not his intelligence. It was his humility. It was knowing what to put in the too hard pile. But you feel like you're missing out. You see your neighbor getting rich on some tech stock. So you jump in with no understanding of the business, the industry, or its competitive landscape. You're not investing, you're gambling. You're playing a game where other people know the rules, and you don't. Here's the rule, the circle of competence test. Before you invest, take out a piece of paper, draw a circle. Inside the circle, write down the industries and businesses you understand deeply, as well as an expert. If an investment falls outside that circle, you don't touch it. Ever. It's that simple. Your homework. Make that circle. Be brutally honest with yourself. Is it small? Good. It should be. Now, write down 3 industries that you will publicly declare are in your too hard pile forever. It's liberating. Truth number 6. You are confusing motion with action. You check your portfolio 10 times a day. You read every news alert. You're constantly buying a little of this, selling a little of that. You feel busy. You feel engaged. You feel like you're in control. You are a hamster on a wheel. Lots of motion. No progress. The single best thing most investors could do is nothing for years at a time. The stock market is a device for transferring money from the active to the patient. Our favorite holding period is forever. We make our money by sitting on our asses. The evidence is overwhelming. Study the long-term records of day traders. The vast majority of them lose money, not just because they're bad at picking stocks, but because of the friction. Commissions, bid-ask spreads, taxes. Every time you trade, you are making your broker richer and yourself poorer. You are a patsy at the poker table, paying the rake on every hand. And yet you can't help yourself. The itch to do something is overwhelming. You sell a great company that's down 10% and buy a terrible one that's up 20%. You're chasing performance, which is the surest way to underperform. You're a gardener who keeps pulling up his carrots to see if they're growing. Here's the rule, the sit on your ass test. Great investing requires a strange combination of patience and decisiveness. You wait and wait and wait. For years, if you have to, for the perfect opportunity. Then, when it comes, you act decisively and with conviction. Then, you go back to waiting. Most of the time, the correct action is inaction. Your homework. Look at your trading history for the last calendar year. Add up every single dollar you paid in commissions and fees. Then calculate the short-term capital gains taxes you paid on your wins. Now look at that number. Stare at it. That is the price of your impatience. I want you to feel sick to your stomach. Then resolve to do less. Much, much less. And finally, truth number 7. The most important one. You believe being smart is your greatest asset. It isn't. Not even close. The world is full of broke geniuses. Temperament is what matters. The ability to control your own emotions. The ability to think independently when everyone around you is screaming. That is the rarest and most valuable skill in investing. I've said it before, if you have an IQ of 150, sell 30 points to someone else. You don't need it. What you need is emotional stability. You need the fortitude to be greedy when others are fearful, and fearful when others are greedy. The smartest guys in the room? Let me tell you about them. Enron. The entire executive team was brilliant. They hired the best and the brightest from the top business schools. They created the most complex and opaque financial structures imaginable. They were celebrated as innovators, visionaries, and they were all crooks, driven by ego, greed, and a complete lack of a moral compass. Their intelligence was not an asset. It was a weapon they used to deceive others, and ultimately themselves. Their brains wrote checks their character couldn't cash. You think your high IQ protects you. It doesn't. It makes you more susceptible to overconfidence. It makes you think you can outsmart the simple rules. It makes you build complex models like LTCM and ignore the simple, brutal reality of human nature. Here is the final rule. The temperament test. How do you behave when you are under maximum pressure? When the market is crashing? When your portfolio is down 30%? When the news is screaming, sell, sell, sell? What do you do? The answer to that question will determine your entire financial future. Your homework. The next time the market drops 5% in a single day, and it will, your assignment is to do one thing. Nothing. Absolutely nothing. Don't check your portfolio. Don't turn on the news. Go for a walk. Read a book. Do anything but react. If you can pass that test, you have a chance. So there you have it, the 7 brutal truths. Avoid complexity. Understand stupidity. Ignore the noise. Don't diversify. Know what you don't know. Be patient. And above all, control your own emotions. You won't get rich next year doing this. You won't have exciting stories to tell at cocktail parties. It's a slow, boring, methodical process. But in 30 years, when everyone else has blown themselves up chasing fads and panicking at shadows, you'll be the one left standing. You'll be the one they're all whispering about. Most people clicked away from this video a long time ago. They're already on another channel, looking for the top 5 growth stocks for this quarter. Good, let them. This advice isn't for them. If you're still here, it means you're serious. It means you might actually have what it takes. This channel isn't about hype. It's not about predictions. It's about enduring, timeless principles that work slowly and reliably. If that's what you want, subscribe. If not, the door is right there. I have to go read. Go do the boring work that makes you rich.